I just wanted to reiterate a little bit about the intuition of efficient markets. The idea is that if you trade securities, the advantage to being there a little bit ahead of anyone else is enormous, right? If you know 5 minutes before the other investors about some good news or bad news, either way, it doesn't matter. You know it 5 minutes earlier, you jump right in and trade. You trade ahead of them, and prices haven't changed yet. You make money. So that has created an industry that speeds information. The first such industry that I would tell you about is Reuters. Mr. Reuters, I think in the 1840s, before the telegraph, created a financial information service using carrier pigeons. Okay, you know these are birds, and so when he was in London with some information, they had carrier pigeons that were brought from Paris, and as soon as new information came out, they would tie it to the foot of the little bird and they'd let it go, and it would fly to Paris. They would go to its roosting place. The message would be read, and subscribers would be notified. And that was no joke. That really worked because you would have information hours or even days before everyone else in Paris, so you could make a killing. So Reuters today, it's now called Thomson Reuters, is still in that business. This was the carrier pigeons were a brilliant idea. But they had to keep up with the times because shortly thereafter telegraph was invented and the pigeons no longer were the leading technology. But maybe that was the beginning of the information age with pigeons. Now we have beepers and we have the internet. A beeper is something you can carry in your pocket that beeps when there's financial news. So suppose a company makes an announcement that it has, say, a new drug that's successful in trials. As soon as they make the announcement, it then goes out electronically everywhere, and the beepers start beeping, okay? And all the investment analysts, they drop their morning coffee, they do anything, because they know they've got to act fast. So you get this new announcement. Now it's T plus 20 seconds. He's got his drug specialist on the phone. Okay, what does this mean? Quick. How much is it going to go up? And so the guy says, I don't know, first thought, maybe it's going to go up $2 a share. Okay, it's only gone up $1 a share. I'll buy right now. And now it's 2 minutes after the announcement. And then the analyst says, I thought about it a little bit more. No, I only think it's $1.50 a share. And anyway, this is homing in, and so the price is jiggling around rapidly as all this is happening for a few minutes, and then it settles down because after, I may be exaggerating, after 10 minutes, they've kind of gotten it. They've kind of figured it out, and it's reached its new level. Okay, they'll still be more. They'll be thinking about it. They'll be thinking about it the next morning when they're taking their shower, and they'll get a better and better, more refined idea of what the price is. Okay. But here's the efficient markets. And you, the next day, read about it in the Wall Street Journal in the morning. You're now 24 hours late, okay? So you call your broker and say, maybe I should buy this stock. They've got this new breakthrough. Well, your broker might laugh at you, right? Because you're 24 hours late. And what do you know, anyway, about pharmaceuticals? That's where the efficient markets hypothesis is true. You can't expect to routinely profit from information that's already out there. If you're going to profit, you've got to come up with something faster, something that you can get faster. The first person to use this term apparently was Harry Roberts, professor at the University of Chicago. But he was made famous by Eugene Fama, who referred to it as Harry Roberts' idea. It was in 1960. University of Chicago is kind of the forerunner in this. In 1960, Ford Foundation gave a grant to the University of Chicago to assemble all stock price data back to 1926 and to get it right. Okay, and so they set up the Center for Research in Securities Prices at Chicago. Okay. The Center for Research in Securities Prices or CRISP as it's called, had a Ford Foundation grant to go to the stock exchanges in the United States and get all the data and get it right. Remember I told you they have splits in stocks? So you'll see the price of a share, and then suddenly the price will fall in half, or maybe it will double, because they changed the units of measurement. No one had, so if you wanted to know what is the price history of stocks over the long haul, no one had ever organized that and figured out things like that and got it right. And when were the dividends paid? When did you actually get the dividends? So they said, let's get it right. Let's put it on, hey, this is really super modern, a UNIVAC tape. Okay, that's a computer tape, all right? We'll put it on a tape and we'll sell it at cost to anybody in the world. That was, and so the Ford Foundation, which is a nonprofit, said, good idea, let's do it. So that CRISP tape has launched a revolution in finance because nobody had the data. They were throwing it away. It was not used. So how do you know what Sharpe ratios are if you don't have the data? I mean, you could find it in newspapers, but it wasn't organized right. It wasn't set out right. So with the invention of the CRISP tape in 1960, it really gave impetus to the efficient markets revolution. And by the end of that decade, there were thousands of articles testing market efficiency using the CRISP tape. And in particular, in 1969, Eugene Fama wrote one of the most cited articles in the history of finance. Was called Efficient Capital Markets, a Review. So he reviews all of these studies of the CRISP tape. And it looked authoritative for the first time because we were using the whole universe of stocks all the way back to 1926. That sounded like a long time and a lot of data. And Fama concluded that evidence is, he said it's not uniform. There are some negative results, but the evidence is that markets are remarkably efficient. And this is a truth that we've discovered. And that, it was really a bombshell because he was discrediting, or seeming to discredit, practically all the investment managers in the country. It was a huge industry. And he's claiming the successful ones must have just been lucky because the market is so efficient that we can't see any way that you could make money in the market. There's been a change in thinking. Efficient markets is still regarded with respect, but not the same respect that it had in 1969 or in 1979. I have here some indication of how thinking has changed about efficient markets. I had the textbook that I used to use for this course. I've been teaching this course for 25 years. Fabozzi et al. Wasn't even written when I started. So I was using a textbook called Brealey and Myers, Principles of Corporate Finance. And I still have all these old editions. It's a very successful textbook. But since I was teaching out of it over all those years, I went back and looked. I don't have the first edition of that book. I have the second edition, 1984. And I was teaching out of it in the same class in 1984. At the end of that book, there's a chapter on the 7 most important ideas in finance. And one of the ideas is efficient markets. And quoting the textbook, Brealey and Myers say, security prices accurately reflect available information and respond rapidly to new information as soon as it becomes available. Okay, they do qualify it in 1984. Don't misunderstand the efficient market idea. It doesn't say there are no taxes or costs. It doesn't say there aren't some clever people and some stupid ones. It merely implies that competition in actual capital markets is very tough. There are no money machines, and security prices reflect the true underlying value of assets. Okay, let me repeat that. Security prices reflect the true underlying value of assets. Okay, that's almost that's a pretty strong statement, right? But that's efficient market. They just said it in their second edition of the book. Not many people would say that, right? Trust the stock market. Don't trust the people you know and love and trust. Trust the stock market. Well, they deleted that from later editions of their book. And I think that's a sign of the sign of changes. So I was looking at the 2008 edition. They've now taken on a third author. They're getting tired of coming out with more and more editions of their book. So they've taken on Franklin Allen from the Wharton School. They've deleted what I just read. And now it says, I'm quoting from them, "Much more research is needed before we have a full understanding of why asset prices sometimes get so out of line with what appears to be their discounted future payoffs." All right, that's a complete turnaround in the textbook. So this is one of the most popular textbooks, and they've changed completely. So let me start, though, with a little bit more history. Technical analysis. This term goes back, must be over 100 years. Technical analysis is the analysis of stock prices, or maybe other speculative asset prices, by looking at charts of the prices and looking for patterns that suggest movements in prices. The classic text of a technical analysis is Edwards and McGee. When the Dow Jones Industrial Average approached 1,000, I think it was in the 60s, 1960s. But it's way above that now, as you know. But when it first approached 1,000, technical analysts said, maybe it's going to have trouble crossing 1,000, because that's a psychological barrier. That sounds magical. How can the Dow be worth over 1,000? Wow, I'm going to sell. And so the idea was that people would sell when it approached 1,000. And it seemed, the technical analysts seemed to be right, because the Dow bounced around just below 1,000 for a long time. I guess it was months or a year. Like it couldn't cross the resistance level. McGee was actually a student of psychology, and he thought certain kinds of patterns seem to have really spooked people. And this is one pattern which he called head and shoulders. Okay, that's the head, that's one shoulder, that's the other shoulder. And he said, when you see this pattern, watch out. It's going to actually totally collapse, as it is shown doing. And so he had you plotting. These are stock prices plotted against time. This is, I don't know what these are days. Each of these points is a day. And this is from their book, so it's a hypothetical. You hardly ever see such perfect head and shoulders patterns. But let me talk about random walk, which is a central idea in finance. And the idea is that if stock prices are if stock prices are really efficient, then any change from day to day has to be due only to news. Okay? And news is essentially unforecastable. Therefore, stock prices have to do a random walk through time. In the efficient markets revolution, they started to realize that stock prices look more like a random walk than a head and shoulders. You look at these head and shoulders patterns, you look for them, and they're hard to find. So what is a random walk? Let me just define it. A random walk is where you have a series x sub t equals x sub t minus 1 plus epsilon sub t, where epsilon t is noise, just unforecastable noise, mean, zero, and some standard deviation. Okay? Ideally, it would be normally distributed, so it would have a bell-shaped curve, and then the math would be very easy and very simple. So I want to contrast that with an alternative, which is called a first-order autoregressive. Let me get my notation here. Let's take a process that starts at 100. That's like the lamppost. And we'll say x sub t equals, how am I putting this? 100 plus some number rho, that's a rho, Greek times x sub t minus 1 minus 100 plus epsilon sub t. Okay, so this is an AR1. That's first order autoregressive. It's like it's like a regression model where 100 is the constant term. Well, 100 minus times 1 minus rho is the constant term. And the coefficient of the lagged x is rho. Okay, and we usually require that rho is between 0 and 1, between minus 1 and 1. Normally, rho is positive. So that means that it's mean reverting, but slowly. You see what this is saying? First of all, in the special case where rho equals 1, well, that would be, I wouldn't call it a AR1 anymore because it reduces to a random walk, right? If you make rho 1, then the constant term drops out. I've got 100 minus 100, so there's no constant term. And then I've got x sub t equals x sub t minus 1 plus epsilon t. That's a random walk, all right? This here is a plot I had. Let's first look at the black line. The black line is the Standard & Poor Composite Stock Price Index in real terms. I have that from 1871 until recently. Okay. That's just there for comparison. That is the actual stock market. Okay. The pink line is a random walk that I generated using this formula and a random number generator that generates random normal variables. Okay? I started them out at the same level, but don't they look kind of similar? I mean, the thing is that if you look at the stock market without comparing it with a random walk, it looks like it has patterns in it. What an AR1 does, say rho is a half. If rho is a half, then it means that if x sub t minus 1 was above 100, last period was above 100, it will be above 100 this time, but only half as much above 100. So it's going back to 100. And then the next time, it'll only be half again as much above 100 as it was the last time. So it tends to go back to a trend. Well, what I've shown here is a simulation with a random number generator of a AR1 around a trend where the trend matches the actual trend in the stock market. Now, in this case, this is not random walk, and there is a profit opportunity. And the profit opportunity is when it's below trend, buy. When it's above trend, sell, because it will tend to come back to trend. So you can see that there's a fundamental difference. The random walk seems to fit the data better than the AR1. The random walk theory says that stock prices are not mean reverting. Where they go from today is all random. If they're above the historical trend, meaningless. The historical trend is just nonsense. It's just random. And forget trends, forget anything. It's always the drunk at the lamppost, no matter where you are in history. But this one, if rho is substantially less than 1, looks a lot different, doesn't it? This is, with rho equals a half, this is not the world we live in. It would be too easy to make money. All these little oscillations around the trend I could profit from. But in the real world, it's not like that. Now, but what about, suppose the real world is AR1 with rho equal 0.99, okay? What about that? Well, that's not much different from a random walk, is it? It's going to be hard to tell the difference. So that in the efficient markets theory period, people were really excited about the random walk hypothesis. That's why Burton Malkiel's book, A Random Walk Down Wall Street, which he came out with, I think it was in 1973, right after FAMA, It became a huge bestseller. It sold over 1 million copies. Because at that time, people were thinking, this is exciting new wisdom. We've learned that the stock market is a random walk, and there's all kinds of implications for that. The problem is, and I have to wrap up, the problem is that the random walk hypothesis wasn't exactly right. It's sort of right. You've gotten some insights, but maybe the real world is AR1 with a rho close to 1. And in that world, there are profit opportunities, but they take a long time to come.